Hey guys, so when it comes to bank deposits, $250,000 is the key number experts are talking about in light of recent financial banking crisis. That amount is the threshold for which bank depositors should be mindful of when it comes to whether or not their money is insured by the Federal Deposit Insurance Corporation or FDIC. The coverage limits are per depositor, per ownership category, or per bank. Deposits below that amount are covered, while money above that threshold may not be insured if unforeseen circumstances occur at a financial institution. Yet the government recently made an exception for people with more than $250,000 of deposit at Silicon Valley Bank and Signature Bank, as they stated that these depositors will be made whole even if they had more than $250,000 deposited in one of these banks. Recently, President Joe Biden said if further instability occurs, the FDIC may guarantee deposits above $250,000 again. The $250,000 threshold was set by Congress in 2010. Some experts say that isn't enough and should be raised. However, Treasury Secretary has said uninsured deposits should only be covered in the event a failure to protect uninsured depositors would create a systemic risk and significant economic and financial consequences. Generally, most consumers do not have to worry about their deposits as they usually have less than $250,000 deposited in their bank account. However, what to do if you are one from those people who have more than $250,000? Here are some tips for you guys. But before this video, guys, please like this video and subscribe to my channel, as it keeps me motivated to create these videos for you guys. Now let's get started with the first tip. Find institutions guaranteeing higher deposit insurance. FDIC insurance generally covers $250,000 per depositor per FDIC insured bank or per ownership category, but certain financial institutions may work around those limits by working with other financial institutions to guarantee higher deposit levels. For example, Citizens Bank of Edmond offers additional coverage with a limit of $150 million per depositor through IntraFi Network. IntraFi Network operates by opening accounts with various local FDIC-insured banks across its large network of more than 3,000 institutions. Customers who use IntraFi deposits are able to keep an account at one local bank rather than at many banks across the network and still be insured for their whole deposit even if it's more than $250,000. Another method is to simply add additional beneficiaries to your bank account. For example, if you have $1 million in deposits, you would only have $250,000 covered on your own, leaving $750,000 uninsured. But if you add 3 beneficiaries, a spouse, and 2 children, that provides another $750,000 in coverage, or $250,000 per person, so long as those beneficiaries do not have other deposits at the bank. Per FDIC rules, deposits owned by one person without any beneficiaries are considered single accounts. However, once the owner of a single account designates one or more beneficiaries, the account may be insured as a recoverable trust account, so long as it meets certain requirements. But be careful with this option, as beneficiaries always get priority over a will. Also, if you name your children as beneficiaries, but they are not yet 18, a guardian will have to take control of the money until they become adults. That can make it more costly for them to claim the money. And the third option is to simply open additional bank account at another bank. For example, if you have $500,000 sitting in your current bank account, just take $250,000 and transfer it to your account in another bank, and this way both of your deposits will be insured. I hope these tips will be helpful for you guys. Also, guys, do you think FDIC should raise the $250,000 limit? Leave your comments down below. So guys, if you like this video, please press thumbs up and subscribe to my channel. This keeps me motivated to create these videos for you guys. Thank you for watching and see you in the next video.